at golf, very similar to trading. But, you know, what sacrifices have I made to get better, not just in life, but in this business? And I think, you know, we would always go back, and many of you might relate to this, about how strict parents may have been back in the old days. And I'm not talking about the new tough love mantra, but remember, you know, mom would always tell you to sit up straight. You remember that? Like, sit up straight. When you meet people, look them in the eye and smile, right? And, you know, you're just a little kid, and you heard that. I don't want to call it nagging, but, you know, I would say manners. If you ever answered the phone and said, what? I mean, it would be a smack in the back of the head. It was always, hello, the person residence, right? I mean, we had this thing about don't slouch, sit up straight, right? How many of us remember all that from parents drilling that stuff in our head? It's kind of funny, but you look back, and I think, you know, those were times where you had those resentments build to your parents, but really, in essence, what they were doing was building, believe it or not, a foundation for success in life, a foundation for success in life in the form of building self-confidence. You know, when you meet someone and you look them straight in the eye and you shake their hand, or, you know, and you get later in life, you know, think of all the people that in the industry and trading of floor trading. I mean, you were trading with someone in the pit and you would look them in the eye pretty much, right? And so you had that, or you'd be yelling or spitting in their face, one of the two. But you would always have that I guess, interaction, and that awareness that those events were helping to build self-confidence. So self-confidence is, you know, I guess a major component of our business of trading. And I just wanted to share some of the stories from my own life of why kind of self-confidence is it's just such a critical topic. It's very important, and it has a lot to do with our algo optimizer, right? Self-confidence and what builds our self-confidence, what builds our confidence to do the right thing. That's what's key critical. And I know that many of us, when we're trading in the markets, and this is a very tricky environment in the market, there's no doubt about it. There's great opportunities, but I think we all need to demonstrate patience, and that discipline is that patience, and wait for the setup. We did a special class this summer. We called it Summer School. And to find your trade and to take your trade, plan your trade, trade your plan. What is that? And, you know, one of the things about the Algo 17, it builds that plan in there and allows you to build upon and change and grow with the markets themselves. And I know that a lot of us have sat there in the market and you want to get in, and you place right on your dome, you place a limit bid, and the market doesn't fill you, and it takes off, and then you chase it. How many people chase the market? You know, you raise your bids on your dome, and all of a sudden, by the time you do get filled, that, you know, you didn't realize that you just chased, maybe in this environment, at least in the last week, maybe a 5 to 7 handle move. And that seems to be, I think, or the market just took off without you. You know, markets are flat for hours. And again, Murphy's Law. The minute we walked away from the trade, that's when the trade triggers, and you're not there because you walked away. You know, or this has happened. You get in, you get stopped out. You get again, you get stopped out. And then you quit and you say, that's no more. I'm not doing it again. And that's the one you should be in, and then you're not. You know, bullet point number 3 is pretty amazing. On our YouTube channel, I shared with our algo product that we created that was initially designed for me to build strategies. And I often tell this, but if you guys remember the XIV, a fund who was using our product shorted the XIV 4 times. 3 of the 4 times lost money. It was kind of like sad, right? And it's like, this thing kind of stinks, right? And they were small little losers. They get short, they got short, they got short, they got short. And the 4th time they got short was around 111 and change. 111, I think 111.83 was the exact precise number on the entry. And the next day, I think it opened just slightly south of 111. It opened, I think, at 11.45 46 or 7. Not 111, 11. $100 difference is when that trade opened. Can you imagine? You're short, you get stopped out. You're short, you get stopped out. You're short, you get stopped out. You nickel and dime, nickel and dime, nickel and dime. And that's that fourth trade, and you decide, I'm not getting in that. I'm tired of this. And bang, that was the big winner. You can find that on our YouTube channel at Person's Planet. I know I put it there. And the funny thing is, you know, they delisted the XIV, by the way. So this is not a bullet point number 3 is something we shouldn't take lightly. And I'm sure we all can relate to that. And then maybe so many times your confidence is so crushed, you're not willing to take any more risks in the market. And that's why I think people need to step back and go back to your foundation and say, you know, my foundation is I know how to articulate. I have at least self-confidence, pride, and go back and refresh your memory. Refresh your memory of when you made money in the market. You know, we did this thing, like I said, in the summer school, guys. If you remember, I said, go find stocks or trades that you've made money on, right, and list them down. And make sure that you know that, because when your confidence is crushed, you've got to know that it was a period that the market was acting weird. And that's one of the neat things about Algo17. And one of the neat things is simply this. And this is the Algo17, and I'm going to share some things with you today that I think you're going to find very incredibly useful about what the heck, and for you that have Algo17, and for those that don't, at least you'll have an eye-opening in what we're doing. You know, we talk about, first and foremost, this is a product that we trade with our JP Asset Management a fund that we just recently lost. You know, in the bullet point that I said, how many times did you get in and you don't get in, you little losses? Listen, here's a market that you could clearly see. Went short, little nick. Went short, little nick. Went short, and guess what? Small profit. Didn't go short. This is a short-only product. This is a short-only product. This is short-only. So does it do any good? Well, the confidence of knowing about the product, let's just say, for example, you know, almost a 2-to-1 profit factor, and noting that the performance graph is a little historically outrageously good. You know, I think we want to rely on what it does best, okay? And that's what it's all about, and the part of trading. You know, whether it's this year, last year, the year before, we have to understand that we will go through periods of losers, small losers. And yes, maybe it shakes your confidence, but you can go back and rely and say, gee whiz, if I missed out on the very next trade or 2 trades later, obviously I'm missing the important aspect of the big wins, right? And riding the trends of the market. So again, the key is when you use an algo optimizer and you are looking for something that can be defining your buys or your sells and your risk reward parameters. And that's where I think you rely on your system to understand, yeah, there might be a period of drawdown, but you have a reasonable set of rules, number one, and you can fall back and say, yeah, you know what, maybe there's some times it's gotten short and it's taken small profits, like over here, and maybe sometimes you go through periods throughout the history. I mean, if you even notice earlier this year, this missed because this is, again, short only, not long and short. We'll go through that in just a minute about what Algo17 is so valuable is. Even though it missed this huge run-up, this is where the XIV went. The XIV went its inverse to the VXX. It would be the same as this thing going long. Can you imagine this thing goes long, gets stopped out, goes long, gets stopped out, and then you don't go long and you get that huge move, right? So the thing about not just automatic systems, but being able to control, backtest, and understand the dynamics of a market, that's what should, the foundation, like your parents telling you as a kid, make your bed every day, right? Stand up straight, look people in the eye. That builds confidence for being successful in your life, right? And having what's called, I would have to say, not just reinforcing your self-confidence, but having consideration for others, which is basically essential to living a successful life. And that's where I find having the essentials for, in this environment, to having a successful trading career. Now, moving left, this is the S&P, the spider. This is a different model. Now, the spider, if you notice, just in case you're not familiar, this is a 60-minute. S&P is the exchange-traded fund on the S&P 500. This is a 60-minute system. This takes longs and shorts. If you're not familiar, blue, it tells you what the signal is, and a blue line is good. It means it goes short and it made money. It reversed and went long. And this actually today, ironically, went short and got out quickly and had been flat. Does that mean it's a bad system? No, it means that there's going to be some trades it's going to miss, just like all of us, but the performance since the beginning of this year is off the charts in a year that has been pretty darn crazy. So with an algo optimizer, what does it do? It's going to help you understand whether you take the trades or not. At least it'll tell you, hey, the system's long and you think you should go short. Is it a reliable system? Does it have more wins than losses? Does it give you, and many of you are already familiar with the fact that these lines are the profits, the losses, the entries, the trailing stop functions. That's what those lines mean. And looking at this market this year, if anyone wanted to say, is this a volatile year? Let's see. It's gone up, it's gone down, it's gone up, it's gone. Yes, of course it's a volatile year. And it's been an active traders market for sure, right? So that's a pretty impressive environment to trade rather than at least a buy and hold market. So I wanted, again, this is a 60-minute chart, and you can clearly see, and I wanted to line this up for you guys. Is every trade a winner? No. Did it take a buy at the high? Yeah. Would that be smart? I don't know. That's the thing. I think we could say maybe the volume looked pretty good and it went long, but if it's not good, it's going to get out when it should. And that's where looking at a system like this, or a strategy building system, is going to help you build self-confidence in your trading. You'd say, well, it missed a trade. It sure did miss a trade. And you know what? Because maybe the parameters weren't conducive for a signal. Maybe the risk was too big. Maybe it didn't give you the sell signal. Maybe it was on the close. There's a lot of different things. So you have to understand the confidence of being successful in this trading business does not come from regret saying, oh, I should have been in every single trade. It's not going to take every single turn in the market. Every single trade is not going to be a winner. You're looking for consistency and you're looking for performance, and you're looking, as you can see, hey, it went short, got stopped out. It went long, got stopped out. If you said the next trade, I'm not taking the trade, the next trade was a winner. So it requires consistency, and that's why we look at types of products like this to give us the confidence to trade better. And year, month after month, day after day, this is a product that has just really come to fruition and helped at least not only my trading, but also for our advisory service and our recently launched fund. So when you look at Person Algo 17, I want to share something with you. This is the E-mini S&P. And this was today, by the way, many of you know this is where I said we went short, and I said ironically it got out of the short position right near our support, and I did a YouTube video for you guys just to clarify that. And then I said it's going to cover the scale out is going to cover that at right around that 95.75, and it did. And 2 bars later, the darn thing went long, got out, and trailed the stop. It max barred out. It did not trade, ironically, until after the FOMC meeting. Pretty wild. Nice day today, good movements, and here's the thing. Let's take a look at the one underneath it. Kind of the same situation, right? Went short, got out, trailed the stop, went long, max barred out, same thing, right? Everyone can see that. So what's the point of having two systems that do the same thing? Here's the point, and this is where we're talking about Algo 17. So since the beginning of the month, this is October 2nd. I'm not sure this is a smooth enough equity curve chart, but this is trading. By the way, I'll share the settings with you. It's set at position calculated method number 3, which trades only 2 lots. So for the month, or for the last 2 weeks, that's the performance and what it has done since October 2nd. So this is a system underneath it, and here's the performance here. Ooh, a little bit choppier, and look at the performance there. Like literally less than half of what the first system did. So what's the difference between a profitable system here, which is this one, and a more profitable system like Stellar, which is this? Did we cheat? Is there different trading times? Is it different size? Well, let's look at that for a quick second. This one it starts at 6 a.m. and stops taking any new trades at 3:30. And it's also position calc method, only taking 2 contracts. Do you see that? Pretty amazing. All right, what about the one underneath it? Comparing an apple to an apple. Starts at 6, ends at 3:30, and still trades 2 lots. What's the difference? Here's the difference, and here's the power of Algo 17. The one below it, really good product. This was our Algo, and I'll let you see this for yourself, number 16. When we go to format the strategy, you could clearly see we start at 6, and end time is 3:30. Position calc method number 3, which is stagnant 2 contracts. $500 max loss per contract, $1,200 max profit per contract. It does not trail the stop, meaning it wants to take the profit immediately, or there's a backup trailing stop feature set at trailing percent 30%. It scales out of half the trades. Now, if it takes 2 contracts, that means it gets out at the intended profit and it'll trail the stop on the balance in case we get a runaway market condition. The risk reward is set at 1-to-1. It's set at 1. It doesn't take reverse signals. It takes buy signals. It takes sell signals. It takes high closed doji, low closed dojis. Holding period, 6 bars. Enter trades at the market orders, true. 0-to-1 is true. All right? Max bars for signals, it's unimportant. So this is, just to let you know, the features that we said, gee, should we opt to optimize? Should we be able to optimize? Should we take buy signals or sell signals? That was the original. Great product. Absolutely. What makes the difference between that and the one above it? Let's get working. Now, one size does not fit all is the old phrase, right? What's good for the goose sometimes, if you're married, you know is not good for the gander. Trades at 6, ends at 3:30. 2 lots, 500, 1,200, same settings. Same settings until we get down to the nitty-gritty. What we found was that buy signals were drastically different in characteristic than sell signals. In fact, the risk-reward on buy signals is 3, and the risk-reward on sell signals was 1. The 16 version did not allow us, unless we built systems separately, to optimize for individual buy signals and sell signals for the characteristics of what your risk reward was and whether or not we should use a moving average for confirmation. And so, by the way, I just thought I'd share with you in the S&P, it optimized out for 17. For a buy signal, it filtered out. We get really good risk-reward ratio of 3 to 1. That's one eye-opening revelation. And next, it did better when the market generated a PPS buy signal when it was above an 8-period moving average. Pretty cool. So what about sell signals? On a PPS sell signal, it said, your risk-reward ratio is better, believe it or not, which is weird, on a 1-to-1, and it's better when you get a PPS sell signal moving average confirmed when it breaks down of a 12-period moving average. Well, that's pretty eye-opening information, by the way. And yet, it also uses the last conditional change. So pretty much what we talked about is, characteristics of tops and bottoms are different. Sometimes we get what's called the V bottom and the rounding tops. Those are quotation marks. Rounding tops take longer to form than bottoms, they say. So in this market environment, it's kind of interesting how we would able to characteristically find out what filters out signals better and under what conditions should we be setting a risk reward. And how did we find that information? We simply click on, for example, buy signal, you optimize it. Should we even take buy signals? 0 to 1, 0 is false, 1 is true, and the increment, jump increment to 1. Risk reward ratio, optimize that. 1 to 3, and I used 0.25% jump factor. Moving average, confirmation. I generally go no moving average up to 12 periods. Now, this requires a little bit of market knowledge. If it's a 15-minute chart, I'm asking for 12-period moving average, which is what? 3-hour moving average, pretty much, right? How many trading hours in a day, plus how many trading hours overnight? So I wouldn't want to go with a start of 0, no moving average, to 100, right? 100-period moving average on a day trade system, probably not good. So I'm using anywhere between a 3-period, 5, 6, 7, 8, 9, 10, 11, up to a 12-period moving average for a 15-minute chart. That's just a little bit of logic of why I would use that, right? And then do we use a last conditional change? 0 to 1, 0 being, again, false, 1 being true, and hit OK, and then just go whack at it and optimize it. We'll get the same settings because this is one that obviously that I use. It's pretty close in how it traded today. It took the same signals coincidentally, but as you noticed in the performance with those extra filterings, it gave a much better, consistent, and close to 2.5 times the profit margin of what the Algo 16 version allowed us to do. If I may, I'm going to jump over because in the old days, about 3 months ago, 4 months ago, 5 months ago, a couple things that we did and I expressed for people to do was to build, and then this is my E-mini day trading page. So in volatile times, I do, and I told you guys in the trading room today, you can have a 2-minute system, and it does pretty darn good, right? And in most cases, we have, as you see, a buy and sell system. And then we have a 15-minute system, and so I have various time frames. On my day trade page, I also have looking at what the 60-minute trend is because I want to look at volume. And as a just as an indication, this is a proprietary volume indicator which works out phenomenally well in detecting, more so than not, bullish convergence patterns, and it also helps us. It's like a momentum indicator that instead of using price, it uses volume. When a stock or an instrument's going up and the volume momentum is declining, okay, it's starting to warn that the momentum buying pressure is starting to weaken. And when you get a sell signal, you can clearly see a crossover, so you see the direction of the volume weakening and the momentum of the volume has turned negative. This morning we came into the trading room and we said the market, we are looking for sell signals, and we said we are looking to take sell signals until the market got down to this little level of support, if you guys remember, if you were in the trading room. If not, like I said, go over to our YouTube channel and look at today's video because I expressly gave that. So using an algo optimizer and using the tools in which we have nowadays available, I mean, we are dealing with quant traders. We are dealing with execution. We are dealing with treachery in the market that is to biblical proportions like never seen before. What do I mean by treachery? I mean, look at the market, how it reacted yesterday's rally. Look at how it sold off today, and look how it rebounded. More importantly, I want you to also, one of the different tools that we utilize is the advanced decline. Do you know, at one point, the advanced decline today, when we started the day off, was slightly biased to the positive side. And I think on an intraday basis, the amount of stocks that were positive on the advanced decline, I think we had an intraday low of 58. Unbelievable. So it went like student body, totally positive yesterday, like 429 stocks were out of 500 were positive yesterday. And then today, we reversed course when the market sold off. The advanced decline, look what it did. It ended up 212. That's powerful treachery of moving markets. It's like moving a mountain. Billions of dollars being moved. So I don't care who you are. You get on the wrong side of a move like this, I don't care how much your parents instilled confidence and how much your parents instilled discipline, such as when you meet somebody, stand up, look them straight in the eye and extend your hand out and shake their hand, look them in the eye and smile. I don't care if they told you to teach you proper telephone manners, table manners. I don't care if they told you to, you know, stand up straight and keep your posture, your head up, your shoulders back, your feet together, right? All of that stuff. How many people remember your parents telling you that, right? Or, you know, make your bed. You're not leaving, you're not doing something until your room is cleaned up. Oh my goodness, right? But you know what that did? Unless you went to the military later in life, it taught you discipline, and it gave you a foundation of building self-confidence is what it was. That's how I relate to my childhood, at least, and why having self-confidence, we will go through a period in life where our confidence gets shaken. But having a system, a methodology that we're able to grow with is fabulous. The Algo17 gang, let me just express to you, we have crude oil, dynamic market mover. And what we had to do is build two separate systems, a long only, a short only, and a model that takes both. I mean, what would be the purpose of that? And I'll tell you the purpose. What we do and train everybody in the room is if we're in a daily buy signal, daily buy signal, and we've got strong volume, we've got our volume indicator. So Jim F., you were asking about the volume indicator. It starts to show as the price is moving down, the momentum is going up. So take a slice of time here for you. Let's take a gander at that real quick. So as price is going down, maybe hard to see this way. Price is going down and the momentum of the volume is turning more positive. And then you get a buy signal and you get that positive thrust in the volume direction. And I want you to just focus in, Jim, just to answer your kind of question there. If you take a look at the volume indicator, you can start to see that the momentum is shifting. If you're bullish and you have a buy signal in the market on a daily basis, why in the heck would I want my system to be taking shorts? if I have a bullish uptrend and the volume is trending higher and the momentum of the volume is trending higher, I'm going to get more fruit off the tree by looking for buy signals than I would sell signal in a trend. And what defines trend? Higher highs in price, prices closing greater than past highs, which is the last conditional change breakout, on accumulation of volume, and maybe with commodities, another little known secret technique called an increase in open interest, which means people are willing to hold more long positions overnight. That takes, well, I won't say what it takes. Chutzpah is a better way of saying it, I guess, right? You know what I was about to say. Mom would not want me to say what I was about to say. So we're going to keep it chutzpah. Now, what if we get a sell signal and, we start to see a decline? We're going to sell signal in the market. Can we improve our confidence by saying, hey, should I be taking buys and sells, or would I be getting more fruit off the tree by taking sell signals in a declining market? Now, as the market's kind of rallying, at this point, the open interest is declining. So let me tell you something. If anyone who thinks that a market that rallies and the commercials and those with large money are getting rid of their long position, if open interest starts to go down, that's not a very bullish sign. It's a negative sign. And look at the volume indicator. This volume indicator pre-warned that the market was losing its positive momentum well before the on-balance volume did, right? So I have a set of factual series of data to help build my confidence. And I know that if open interest is going down and the market's rallying, it's a matter of time. And if, by the way, as the market's going up in price, the momentum of the market volume is declining and the open interest is declining. By the time we get the sell signal, which came right against this line, October 8th, the open interest already declined, the volume already declined, and you're in a PPS sell signal. So now I should have ready at my beck and call a system that maybe takes crude oil and only takes maybe short side trades. Only take shorts. Oh, wouldn't that be nice to only take shorts in a market environment that has negative or bearish characteristics? Now, this system here gives you where to enter the trade. It has the profit target. It got out, sold 2 contracts, gets out at 1 at the intended profit, and then trailed the stop on the balance all the way till about there. And then another new series or sell signal came in, and it got out, and then what did it do? It got stopped out on the balance. It did its job. So having the confidence and having a tool that can help you to formulate and maybe break up, so to speak, whether or not you should be taking buys or sells is important, but more importantly, find out whether or not the characteristics, are you getting a bigger risk-reward ratio on the shorts, or are you getting a bigger risk-reward ratio on the longs? That was a very interesting find, and that was the main reason. And if you think about it, you've always heard that rounding top and that V bottom. Bear markets have different characteristics than bull markets. That's why they're different, man, right? I mean, I don't know if anyone's been a floor trader or been around a long time. Bull markets, and most traders these days are new traders in the last 5 years, have only been around for a bull market with a couple corrections around. They haven't sat through bear markets, and we have not had a bear market in a long time on any front for that matter, not even bonds yet. And hopefully we get a bear market movement in the bonds. But here's the story, guys. I guess you want to say we've had a bear market in grains for a while, and that looks like it's coming to a change. Every type of buy signal and the characteristics and are giving us different layouts, different risk-reward ratio. Here's a low close doji. right? Risk-reward ratio on a low close doji is a sell signal, and that's a 3-to-1 risk-reward ratio. But look at this. A PPS sell signal had a risk-reward ratio of 1. So why is Algo 17 more impressive and more advanced? Because it tells us when we were running optimizations with our other product prior to this, it was giving a generalization of the best average risk reward for longs, for shorts, for high closed dojis, for low closed dojis. It was doing it all and giving out the best average. This is giving us the more finer devil in the details, a more sophisticated and more advanced, more technologically up-to-date product for investors, retail traders. That's what's the difference between Algo 17. And I don't think anyone has anything close to this. I know that the high close doji is a proprietary pattern that I copywrote and wrote in a book, and it has a set of rules. We did that almost now 14 years ago, excuse me. The PPS is a proprietary momentum indicator, widely used by institutions, It's on Thinkorswim. It's one of the most popular buy and sell indicators or bullish bearish momentum indicators that Thinkorswim has. And it is, you can use it to run scans. In fact, gee, what a coincidence, guys, right? Part of the whole thing about being a robust trader is we look at this scan right here, JP buy number 4. Those are for PPS. Those are daily buy signals for PPS. Scan sell signal number 4 are PPS sell signals. It just, no filter. That's kind of like, it tells me at the end of a day or a given time period, how many new fresh sell signals did we get? Like, so for today, out of, watch this, guys, ladies and gentlemen. I'm running a scan for the S&P, the New York Stock Exchange, and the NASDAQ. A boatload of stocks, correct? More so than you probably would want to run for your own trading. Buy number 4. Let's just make sure we're comparing apples to apples. Buy number 4. S&P, nice, NASDAQ. Okay, we're running the same. Now, I'm not sure if there was a crash or not, so there was. So this was from yesterday. We didn't, buy number 4, I didn't want to run scans in the middle of our presentation today. But sell number 4, after today's action, generated 90 new sell signals. Obviously, IBM. Interestingly enough, Momo. You can see how many stocks, where the heavy concentration of sectors were. A couple financials, a Treasury ETF, IEF, that's the iShares 7 to 10 year bond. A few in the healthcare, and then not anything that really stands up, I mean, meaningful. Nordstrom's, I mean, not a meaningful amount of information. After our webinar, I will run, and I like to run sell number 4 and buy number 4 and compare the two to find out how many fresh buy signals did we get and versus how many sell signals. That's got to be one of the better ways to understand if there's more positive breadth in the market or negative breadth in the market. But what I want you to walk away with today is that you now have, with Algo 17, whether it's a stock, whether it's an ETF, if you're an option trader, you now have the ability to back test, to find out the characteristics of the market in the current environment in which we're trading. I would never tell someone to back test a system which would include the last 20 years of the S&P 500. You'd have to take it in a slice of time. Why? 20 years ago, the S&Ps were not trading at 280 with, here's the best part. The S&Ps, I doubt 10 years ago, we had an average true range of 4.82 points per day. I just don't think so, all right? That's the number one issue right there. And so when you have a product like an algo optimizer, how does it help you build self-confidence? You're going to know that not every trade's a winner. You're going to know that it definitely will cut your losses at appropriate time. And you will know that even if you don't agree with the trade, even if you don't agree with going short, at least you have an idea of where your stop loss is, which is that red line. Here's your entry, and there's your profit target down there on that particular move. How about this one? This is bizarre as hell. Here is your sell signal. Here is your risk, and it was giving the profit target way down here. Now, when was that? Of course, it overshot the runway a little bit, but at least you had an idea. If you were an option trader, you could say, maybe if I'm going to buy an S&P put, perhaps maybe I could use the weeklies, and therefore know what is your average holding period. You get in a long trade, it's 1, 2, 3, 4, 5 days, and it flipped into a new or a reverse position. You'll be able to know what is your average holding period. How long does it take to have a winner? How long does it take? And that's what we have to teach you, is to understand the system, and not just the system, but the dynamics of the market in which you're trading with more factual information. So whether you're a day trader in the E-mini S&P, whether you're trading spiders, whether you're trading Apple, whether you're trading Amazon, whether you're a weekly trader or a monthly trader, you can dynamically find out what the characteristics of that market is and what its dynamics of risk-reward ratios can be. So that is one of the things for the Algo 17 that was just, we went and we took what was an amazing idea to help for us, and when I say us, I mean my partner Ben and myself, to develop some strategies. And that's how this whole thing unfolded. And we had a fund that used it, and they said, we want this thing. And then we kind of kept working on it and improving it. And how did we improve on it, and how much work did we do? Well, just to give you an idea, I'm sure a lot of you are familiar with this. Let's go to Insert Strategy. And just so that you can see my computer, we had version number 1. We had the original one, which I've taken off. We had this one. We had that one. We had a latest. We had a different test one. We had, this is probably, believe it or not, the 19th or 20th version, even though we call it Algo 17. We didn't even release some of the other ones that we had on people. The original version was dynamic, but to separate the risk-reward ratio, to separate and add confirmation, should you be using a moving average? In other words, if I take a sell signal, is that good enough, or should I have a breakdown of a moving average? Would that improve my results? And that's what's dynamic for discovery of information to give you a better edge of trading. So whether it's bonds, whether it's gold, whether it's silver, I think that the age-old questions of, are you in? Are you able to miss it? If I'm bearish the market and I'm looking for a sell signal and I see the daily trend is down and I see the open interest is declining and I see all of this information and I got to go tinkle, you know, Murphy's Law states the minute I go walk away or I answer a phone or something, that's when the sell signal comes and I've missed it. That's part of why we need a product like this. And so, worse yet, you get stopped out of a trade, your buy signals say to reverse, and then you don't do it. Your signals say, oh, go short, and you don't. And that happens to me. I mean, I'm not alone. This really is a product that has given people access to what a prop firm's trading system or components that go in them. Absolutely. The components so that they can find out, and you can bet your bottom dollar, people don't go in just to trade on the flip of a coin. These guys that are hiring mathematicians, I mean, you think about it, they're really, what are they basing their information off of? Markets are built on what? Open, high, low, close. And over time, and you got some other things like volume, and you got a few other little issues as well that you can incorporate, correlations, etc., etc. But for the most part, most systems are built on open, high, low, close. But what's the dynamics? I can't explain this, gang, but I mean, it's just freaky. Both systems, I wanted to share this with you today. Both systems, the old version and 17. I mean, obviously it was kind of impressive, and that's building a model, right? Both systems did what? They had almost very similar trades today. I mean, and they all kind of figured out where to get out. And that, my friends, was like the low of the day. Really bizarre stuff, right? And then when the momentum changed, they both went long. One just made a little bit more money than the other. And how does it do just over time? You know, having a better setting can give you the difference between a nice return in a very short period of time versus an okay return with a lot of choppy heat in the trade, right? So I'm pretty sure, I'm not going to insult anyone's intelligence, which model would you rather trade, right? One that takes better confirmed signals with more defined risk, one that has better parameters on longs versus shorts, or one that just takes longs and shorts with the same type of risk-reward ratio for longs and shorts? And the answer is you want 17. So that's what's in your hands, 17, and that's some of the dynamics about how to use it. So it helps us build that confidence. You know, I keep going back to mom, you know, and building that confidence. I don't know about you, but, you know, my mom, and I talk fondly of mom because some of you guys know this. My mom passed away unexpectedly about 10 days ago. And, you know, I think back of all the times, and I mean it too. I was a hockey player as a kid, and I was a really good hockey player. But man, if I misbehaved, that was the carrot that got yanked away from me. If the room wasn't made up, if I misbehaved, imagine me misbehaving. There was no hockey. I wasn't going to hockey practice. She wasn't going to drive me. And so you could bet your bottom dollar the bed got made, and that gave me that instilled that level of confidence or discipline in my life to a degree, right? And that's what, I'm not trying to say that confidence comes from within, but, you know, it really does, right? And I think trading is a learned skill, and you need to have confidence. And where do you get that confidence from? If you're trading alone at home, obviously, you know, once in a while you're going to get smacked in the face. But having something like this with cutting-edge technology and great auto execution, or deciding whether or not you want to execute it or not. Remember that. You can go over here, if you go to Format Strategies, generate the trade for auto execution. You can have that just hit I agree, and auto account with confirmation. It says, do you want to enter this trade? Yes. If you want to just have it automatically, don't even warn me, just put it on. It's going to do that as well. So that's part of what's dynamic about the market, at least with TradeStation's functions that we were able to build upon. That's what's really amazing, right? So you can use it as whether it or not you want to use it as an indicator. I mean, I would trust this before I ever used, knock on wood, forgive me, George, I would use this before I ever used George Lane, a stochastics, a Bollinger Band, or any other tool. If this thing's generating consistent results over time and it says to be short, then I want to take a look at that, right? So I have that function in the market. And that's why Algo17-Xtreme, I mean, it's 9 years in the making. It did everything we possibly could want to help us control and optimize, not curve fit, but optimize for when volatility changes. And what does that mean? What does volatility mean? It just means that the true ranges, we go from periods where in the S&P a year October, we had a 9 handle, 936 ticks in even the S&Ps. That means the spiders were moving like literally less than 80 cents. It was brutal, right? And now we're at $4.80. So when we get bigger daily trading ranges, we got to do one or two things. Drop our lot size down, drop our time frame down. And when volatility contracts, we need to increase our time frame or holding period. And we would also need to do what? reduce our profitability targets, right? So that's where you have that function to change that optimization. And that's what the dynamic thing is. You get to choose your optimized settings for the time frame you wish to trade, separate the buys versus the sells, and not just the buys and the sells, but the high closed dojis and the low closed dojis. And then we added this function about should we use or I only want to take it if there's a moving average confirmation tool. So that to me was the real eye-opener. And as I shared with you today, obviously longs versus shorts all came up with a different moving average, which makes sense since we all probably know that tops take longer to form and bottoms are quicker to form. So you don't want to have a 50-period moving average when you're looking for and the market's forming one of these V-type bottoms. We can choose the same thing with the all other models, just to remind you guys. Same functions we did, just kind of improved upon. What we did is we improved upon the start and end time on our optimization, or if you wanted to only trade like the first hour of the day or the second hour of the day, or if you wanted to trade European session if you're Forex or if you're trading markets in the European session. So you could have that function, and that's what I meant by this, right? The time sessions you wish to trade, that's what that means. So you can auto trade it. Just, hey, I'm more interested in only taking sell signals to give me a better edge when a daily PPS and I've got strong indications that the market is in an uptrend. I only want to take buy signals. When I'm in a daily sell mode, you know what? I don't want to take intraday buy signals. I'll take intraday sell signals. That's pretty cool stuff, right? And the markets you want to trade, whether you want to trade bonds, and more importantly, gang, I'll share this with you too. This is important. So let's say you have a product to trade besides the spiders. This is my volatility page. We created, or I created, my partner and I, we created a series of different models, right? This is a model that goes long and short. This is a model that goes long and short. This is a model that goes short only, short only, short only, short only, and this is a kind of a day trade system that takes all hours, all hours, all hours. So the model that you would want is if you optimize different models, different time periods, wouldn't you want, if a system takes longs and shorts, if you would get a model like this, a page like this, and then all of a sudden, this is short, that is short, this is short, that is short, this is short, that is short, and this is short, all at the same time, and you're thinking of going long, I think you'd reevaluate things. You know what I'm saying? I mean, you would significantly reevaluate that. So when you're in sync with your short models, short model, out, short model, out, short model, out, and you don't get out and you're still short, you're not adhering to your business practice. Short, out. So when you have all of these systems and they go short, and by the way, that is an actual one of our trades that we did. We got out today. We were short the VXX, and that's part of the thing that I think is really critical for traders, is not to think one-dimensional, but to have better confirmation if you have the tools to put the edge in your favor. Believe me, professionals are doing it. I don't know why retail traders should take the time to learn to do this, and certainly grab the opportunity to take a product like this and embrace it. It's just amazing. I mean, I hope you can feel the excitement here, because this is just an amazing product to be able to say, I can develop consistency and I can learn to trade off of a rule-based approach and at least give myself a better edge than you've ever had before. And I think that's what's really important, and that's why that confidence is so key critical to markets. I do want to let you know, if you want to take advantage of the Algo 17, or if you want to learn more about it, call our office by any stretch of the imagination. You can always we'll give you some ideas on who is it for. It might not be for you. If you're just trading a small size account, I'll be honest with you, I don't think this is for that kind of an individual. Someone who's day trading on $500 or $700 margins and has a small account, this is not that product for you. This is for more of a professional round-based trading. But we do have the online trading course, the trading manual, online video instructions, our monthly webinars like tonight. And again, we have always put out free upgrades and new features in the past. That has to end, though. There's too many things that are coming out. The clientele base is getting too big, and everyone gets what they get. We've never, ever not promised. But anyone that does have this is grandfathered into this. You will never be charged for any new feature. But after December 1st, and I'm not sure, we debated this internally whether it should be the beginning of the year, the end of the year, but December 1st, because our company shuts down for the year in the middle of the month of December. So therefore, December 1st, there will be a $500 annual fee for any upgrade. Doesn't mean you don't have to pay for the upgrade. So if you say, well, I'm going to buy this next year, go ahead. No, not a problem. The Algo17-Xtreme, we do not have repeat. We do not have limited licenses anymore for that. We can market this, which we haven't. I don't intend to, but it's not limited like the original version was because we made this so robust and so extreme, and that's the name, 17-Xtreme. Because of the moving average, because we separated buys versus sells, because we're able to backtest risk-reward ratio on longs versus shorts, all of that was pretty much a new function. And therefore, I don't think anyone's going to be able to come up with the same exact settings or systems, more or less, especially with whether or not you want to take a last conditional change or something like that. But if you don't have the product, or let's say you bought the Algo product and you just haven't gotten the file, certainly call us. This is there for you guys, right? The annual fee is just in case we come out when we come up with updates, upgrades constantly. If there's a new function, a new feature, again, you guys are grandfathered in that. But after D's first, there's going to be a fee because the cost of doing business, internet work, and you guys will know this for yourself. Computers cost more money. Routers cost more money. Internet's not freer. It's more expensive. I mean, it's supposed to make our life easier, and things are getting more expensive. And for that reason, we need to cover the cost of our development, and which is not free. So that's the nature of it. More importantly, we are having a seminar, or as important, we're having a seminar here in South Florida, Thursday, November 29th, Friday, November 30th, Saturday, December 1st. Yes, we'll be going through the algo trading. We'll be going through VIX. We'll be going through how to use my relative strength tool, the lifetime package, this function here when I talk about the person's market catcher, how to use the person market catcher more efficiently to find trading opportunities, what sectors are doing better, such as right now many of you might be shocked to find out that probably one of the strongest outperforming sectors right now, not just consumer staples, one that we're also trading in, telecoms. Telecoms are outperforming bright blue. And again, versus the S&P, the Qs are outperforming mildly versus the S&P. There's the Qs right here. Outperforming. Here's the relative strength person market catcher. So at this point in time, I wanted to say our 3-day seminar will help solidify anyone's questions if you have this. It's great, and I know you're going to have more questions regarding how we put together, or when, by the way, when would I put on maybe a leveraged ETF versus a regular trade? And the answer is real simple. When we actually start breaking out and forming a trend on higher volume and higher relative strength. Jim F., this one's for you because you were asking about it. When we get a stronger volume reading, we need the moving averages to kind of move up and give us a stronger volume reading, and the relative strength improves. That's when we get a more meaningful upside. We're starting to see the relative strength improve. It's fuchsia. We're starting to see the volume uptick. So if we can get a couple more days of that with the seasonality of the small cap Russell, I see at least TNA a little bit more upside there, and that's part of what we're going to go through. So I hope we answered some of your questions for this. The seminar for the 3 days is $14.70. Why 78? I don't know. It's $14.78, $14.75, $14.80. I'll throw a buck in. We'll call it $14.79, something of that. Paul's a little bit too far to fly from New Zealand. Yes, it is, Paul. I'm not going to lie to you. That's we went to. By the way, Paul, went to Australia. It took me, by the time we flew back, I think we were 10 days there. We were there with the Australian Technical Analysis Society presentation. Went to Brisbane, went to Sydney, and I mean, I just couldn't, man, that was the roughest jet lag ever. But visit the website, personsplanet.com. First and foremost, if you want more information, it's under advanced, and here's our seminar in Florida. I think we have the link that's already been put into there. No, it's not being held in Singapore. This is just a photo of me giving a presentation on behalf of Thinkorswim at the time. And it's just I don't know, it's a good photo of me giving a presentation. That's all that is. That's number one. Number two, if you're interested in more about the Algo Optimizer, first and foremost, go over to Persons Indicators and click on Algo Optimizer. And you'll read a little bit more about that information. I hope tonight cleared up some answers and the dynamics about, again, this, not just the market, but more importantly, how to put together a better trading model, number one, and the dynamics and the importance of price discovery and data discovery. And data discovery is just this. Are we getting better moves on the upside, or are we getting better moves on the downside? Is there higher risk-reward ratios? Is there a shorter holding period on longs versus shorts? Instead of one size fits all, because again, markets that go up act differently sometimes than markets that go down. With that said, I thank you all for your time. I hope you got something out of this tonight's presentation. And once again, if you'd like, you can always visit the website. I update the YouTube channel with trades, generally the ones that we are taking in the trading room that we that maybe if you had questions on, or that you could see what I was referencing. So for those that don't know where to find that, you go over to right there, the YouTube channel. If you go to that YouTube channel right there, I didn't send an email. I tweeted it out